Hello and welcome everyone to this MNI webcast. I'm Luke Heighton, Senior ECB Correspondent at MNI, and it's my pleasure to be your host on this occasion. I extend a very warm welcome today to our speaker, Joachim Nagel, President of the Deutsche Bundesbank and, of course, a member of the Governing Council of the European Central Bank. President Nagel very kindly joins us to discuss monetary policy challenges and the economic outlook for the Eurozone and Germany. I think we can say at the outset that there continues to be no shortage of economic and policy challenges for the Eurozone, generally, and Germany in particular. It will be fascinating to hear President Nagel's thoughts and perspectives, and of course he believes the ECB should plot through these hazardous waters. Our distinguished speaker, a PhD economist, returned to the Bundesbank to succeed Jens Weidemann as president from the start of 2022. This followed an initial 17-year period at Germany's central bank up to 2017. The last six of which were on the executive board. In the intervening years, he joined the executive board of the KfW Group and moved on to become deputy head of banking at the BIS before coming back to the Bundesbank. This MNI webcast is fully on the record. President Nagel will make some opening remarks, after which I will raise questions which we have drawn up. We invite our audience to also raise questions by submitting them via the chat box. I'll be monitoring these and can raise some of them as appropriate as we go along. We're scheduled to run for approximately an hour, perhaps with a little bit of injury time if needed. Thank you very much, Dr. Nagel, for being with us today, and the floor is yours.
Good morning to everyone. Good morning here from Frankfurt. Thank you very much for having me. Hey, it's a pleasure to give you a little bit some, let me say, insights regarding my understanding perspective, where we are when we're talking about inflation and the whole economy. I guess maybe not a surprise to you that I'm rather confident that we did it right in terms of what we did by hiking rates 10 times. Last rate hike back to September. It looks like when we take our three criteria, inflation outlook, dynamics of underlying inflation, and the strength of the monetary transmission, it looks like that, at least for the moment, checking the data, that we are back to our 2% target on average in 2025. And so I guess this is good news. I said I guess it was early last year, when I said the greedy beast inflation. So I would change a little bit now the headline. The greedy beast inflation is still twitching, so it's still there, but it's a little bit something more we have to do really to tame than this greedy beast. But it seems to be the case that we will achieve our target next year. I know that many of you will be interested to hear from me, what does it mean for interest rate outlook? When will be maybe the first cut? I think I said it several times after our last meeting that I believe now that the probability is increasing that we will see the first rate cut before the summer break. But I guess it is also important to say here that it is dependent on data. And this approach, and it's not just to, some of you maybe might say, well, this is an excuse. You're saying this every time, you're data dependent. But I guess this is not, shouldn't be perceived as an excuse. I guess it was the best way in a really complicated environment. The circumstances were very difficult after this unprovoked war of aggression of Russia against Ukraine, starting the 24th of February in 2022, with this development regarding the energy prices, inflation rate up to 10%, in some countries of the Euro system, more than 20%. So it was really a complicated situation, and the whole geopolitical setup. I think it was clear that the best way should be to wait for the next meeting, see what the data will give us as an indication. And this will also work for what we have maybe in mind for our next meetings, and then we will see. But as I said, the probability is increasing that we will see a rate cut before the summer break. And often I hear the question, well, does that mean there is a sequence? Maybe if you start cutting rates, does that mean there is a sequence of rate cuts? What I would like to emphasize here, that I do not see that there is a kind of an automatism. If you start such an let me say, cycle that you're starting to cut rates, that does mean that the next meeting there's another rate cut. As I said, it is also true for all what happened after these meetings when we had the first rate cut. It is data dependent, and it is not a done deal that everything is going smoothly for the rest of the year or maybe for next year. So we have to be vigilant, we have to be cautious, and this is my understanding, my approach to do monetary policy. And yeah, I would leave it with this. I'm open to your questions and happy to discuss all the things I didn't address in my introductory statement.
Thank you very much, Dr. Nagel. It was excellent. You mentioned there that you think the probability is increasing of a rate cut before the summer. ECB communication seems very much to be geared towards preparing us for a June cut. Does it follow, therefore, that April is completely off the table? Might June be too early yet, in your view?
I think, as I said, I think April, we have to discuss this in April. As I said, we will see then what we have then on the table, what it depends on the data itself. So right now, I would say I will not speculate here. In general, I think we should remain, as I already alluded to, cautious and vigilant, and then we can discuss that in April. But as I said, if I would more or less put that into probabilities, definitely something in June has a higher probability than in April. This is for sure.
Sure. You mentioned also that it is looking increasingly like inflation will be back to target by the end of 2025. Do you see any possibility that we could be at target before then, in the last quarter of 2024, for example? And do you think markets are perhaps ahead of themselves in the ECB, or maybe correct in expecting around 175 basis points of cuts by the end of next year?
I think markets from time to time, they're right, sometimes they're wrong. So I will not speculate about what I think about the current market expectation for the interest rate development over the year. Just to give you maybe a little bit my understanding where I see maybe the uncertainties, and that's the reason why I said we should be cautious. Take, for example, energy prices. The energy prices, they came down compared to last year significantly. If you take, for example, gas price, it's roughly around more than 40% below the level 12 months ago. So there is not a certainty that this is something very stable. So we have to really look into all what is important to look at when we are talking about inflation. So I'm checking every morning energy prices and getting a little bit of feeling, and I'm finding out on a daily basis there's still a rather high volatility. So energy prices is an uncertainty. Then, not a surprise to you, wage development. Take, for example, Germany. So a lot of is still in the pipeline. Wage negotiations are ongoing. So I guess, especially in June, I think we will get a clearer picture about the wage development over the course of the year 2024. So wages, uncertainty. Also the profit development, it's more or less the same. Profits are still on a rather high level. So we will see, is that something that is might be balancing out, maybe the higher wages we will see over the year, or is also some push regarding inflation coming from the profit side. There are still some open issues. And so, as I said, this meeting to meeting approach is the best way to address the current situation.
On that point about wages, I think towards the end of last year, there was a moderate decrease in negotiated wages. And some people are expecting that Q1 will be a little lower again. But I wonder whether you think that will be the case. I think you suggested there may still be some push from wages. Would a decrease in negotiated wages be enough to convince you that there isn't a risk of wages getting into rather sticky territory or not?
Yeah, I think this is pure speculation. I have to look at what I see from the data side. And taking my country, in Germany, we still have strong wage increases in Q1, so this year. This was due to very large pay rises in the public sector in March. And what we still observe are quite high pay demands by unions. So a strong willingness to go and strike and high realization rates of union wage demands. So in the end, workers aim to get a permanent compensation for real wage losses in the previous year. So there is still something, as I said, in the pipeline, and we have really to look. We really have to look at it. What does that mean? Is that something this is sticky? Is it something that will more or less diminish over the rest of the year? But at the moment, I would say it is too early to have really here a clear picture. I have still so my feeling still is rather opaque, and we do not really know. So as I said, waiting a couple of months, see what the data will give you as a new indication, then you have definitely more clarity when it comes to wages. But also look, to make that crystal clear, I think central bankers, we are asking for data. This is our job. But also, we are not naive in a way that there is never be a situation where you have a complete and full picture. When you're doing monetary policy, there is always a certain level of uncertainty. But for some data, the situation regarding data and what does it mean, implications for monetary policy, it will get better over the course of this year.
Thank you, Governor. That was excellent. I mean, I suppose just a quick follow-up. I mean, on the data specific to wages, then. I mean, is there data that you look at beyond the ECB's own wage data? I mean, wage data is, of course, something of a backward-looking indicator. How do you weight the importance of wage data then in your overall assessment of the outlook?
I think it is an important aspect in the current situation. I think, especially when you see that there is still some dynamism, some dynamics here from the wage side. So we are really looking into all what we can get to get a better understanding about the wage situation. We are using real-time data when they are available. So I think it is complicated. This is one of the areas, I guess, where we have to do more work to collect more data, more reliable data. Often you have a little bit the feeling that it is too much backward looking, and then it's difficult to get a clearer picture. What does it mean for your models, and how does that more or less be translated into inflation? So as I said, this is a complicated field.
Thank you, Governor. At this point, I'd like to remind our audience that we're very much open to hearing your questions. So please do drop us a line in the chat if you have anything you would like to ask Dr. Nagel. Just on the inflation outlook again, then, I mean, are you at all concerned that service sector inflation has started to reaccelerate?
Well, I'm, let me say, a little bit puzzled by the service sector. I read a piece that was published by the BIS, and that came to the conclusion, and I have some sympathy for that argument, that the service sector and the inflation development in the service sector seems to be rather sticky because of the simple fact that it's very labor intensive. So wages went up. When you are in a sector that is labor intensive, then it seems to be a realistic picture that this does mean that also your inflation picture is different from maybe other sectors. It looks like, and then comparing this with previous cycles, it is pretty much the same, that the service sector, there it takes much more time to come back to your 2% target. So yes, there could be a situation that we have really to look also very closely what the service sector gives you as an indication regarding the future development of inflation. So as I said, I have some sympathy for that argument that service sector related to inflation seems to be more stubborn than maybe other sectors.
Thank you very much, Dr. Nagel. We ran an exclusive story yesterday that suggested that it was Source's piece that suggested while the Fed won't drive ECB interest rates policy, it is nevertheless relevant for the ECB, especially if there is any chance of a significant divergence between the two. What's your view?
I know that there's often this speculation that when we are doing our discussions in the Governing Council, how much is maybe being discussed, what is decided on the other side of the Atlantic, what our Fed colleagues are doing. But it is not like this. I think we have to do our job. We have to fulfill our mandate, and this is for the Euro system. So the best way, more or less, to do this and to achieve your target is to make yourself independent from decisions that were taken because of completely maybe different reasons in other, let me say, jurisdictions. So I'm really convinced that it is the best way to do it by looking what's going on in the Euro system. Yes, I'm also interested to know what the colleagues of the Fed are doing. But for me, for my job, there is not that relevance that is seen often by that piece you alluded to that you made yesterday. So I'm really concentrating on the facts I have for the Euro system. And this is more or less leading my decision within the Governing Council.
Thank you, Governor. That was very clear. I'm sure our audience will have some more questions on that topic. But I wanted to turn, if I may, to the German economy, which faces challenges of its own. You have pushed back rather strongly against the suggestion that Germany is in the process of becoming or has become the sick man of Europe. But I wonder, is there a trend towards deindustrialization in Germany? And if so, does this have implications for ECB monetary policy?
I think, first of all, let me make again the point, and you mentioned what I said when I referred to that, what I heard many, many times, that Germany is again the sick man of Europe. First of all, this is not the case. And this is also true. I think I'm not happy that the German economy is not doing well, at least for the moment. I think the growth rate, I think we came out yesterday with a piece and forecasted for the first quarter of this year that there maybe is again negative growth for the first quarter. But the outlook over the rest of the year, maybe it will get better in the second half. Then we can talk maybe about a situation that is stagnating, but growth is not enough in Germany, this is for sure. But there is a difference between the situation we had 20 years ago and the situation now. Labor markets are close to full employment in Germany. It's a completely different situation compared to 20 years ago. So this is something we should discuss. We should find more or less the reasons why we are in a situation that the growth rate is on such a low level. And we have to do our homework when it comes to digitalization, decarbonization, how to deal with maybe a world that could be more or less getting more into a direction of deglobalization. What does it mean for the industry and so on? But we have to talk about Europe, capital market union, banking union. So there are different things that have to be fixed. And I'm convinced if that is the case, then also Germany has a good potential to have a better, let me say, outlook for the next decade. But also we shouldn't forget that where we all came from, we came from a situation in 2022, energy prices, take for example, gas price, 300 euros per megawatt ton. So really a situation of stress. Politics achieved a lot to overcome this situation. And yes, we have to deal with, let me say, political issues. We thought years ago that this would never take, or would never be the case again. For example, defense spending and so on. So we have to do things that are distracting ourselves a little bit because of the financial resources away from all the other things we have to fix. So, but as I said, there is a good probability that we will overcome this, but we have to do our homework. Coming back to your question regarding deindustrialization, no, I think the manufacturing sector remains highly, it's very highly significant for the German economy. So the share of the manufacturing sector in total gross value added stood at 21% last year. So this is more or less on the level of the years before. So there is not that deindustrialization momentum that often some commentators might see in Germany. This is definitely, if I take the data, this is not the case.
On a related point, then, can I ask about the role of fiscal policy in helping to boost German growth and to some extent restructure its economy? And first of all, from a central banker's perspective, do you regard the current German fiscal policy setting as expansionary, perhaps too expansionary? Is that a problem? Might that yet be a problem for domestic inflation? And how do you see the recent Constitutional Court ruling on the application of the debt brake and indeed proposed moves to circumvent it during periods of economic weakness functioning in practice? Do you see risks to growth and inflation coming from either the debt brake's application or its circumvention?
I guess I have 2 hours for answering this question. But okay, let me try to give you, nevertheless, a brief answer or my understanding. I think starting with the constitutional decision from autumn last year, I think this decision by the German Supreme Court, located in my hometown, Baden-Württemberg, Karlsruhe. So let me put it like this. I think this decision brought clarity. And this is important when we are talking about fiscal policy. I think to have this clarity, what the budget should do and what the budget should not do. And now we have this clarity. It was a complicated situation for the German government last year or at the beginning of this year, but I'm now convinced that everything is fixed for the budget this year, and I think this is good news. If you take the German deficit ratio, if you take the German debt to GDP ratio, Germany is again and still this stability anchor in Europe, and that is also an important element here, I think, to have this. And so I believe this is good news at all. Now, the complicated question is, what is fiscal policy at the moment? Is it expansionary? Is it more or less giving a neutral stimulus, or maybe is it restrictive? So my perception, what I can see or what I can take from the data, it looks like in terms of monetary policy, where I have to look at, it seems to be okay. It's not triggering too much problems in terms of what we have to do on the monetary policy side, but we should be very cautious. I think the extraordinary times, they are now more or less over. So we have to go back, not only in Germany, that is true for all European countries, back to a more sound and robust fiscal policy in terms of going back to our targets. And so for that reason, I believe the debt brake is playing an important role. We had a very intense discussion in Germany about the debt brake. We published a piece here, the Bundesbank published a piece here about the debt brake, and we see maybe under special circumstances, when maybe the debt to GDP ratio is falling below 60%, that there is maybe some flexibility, more room to maneuver. Also, we should think about the distinction between investments and consumption expenditures. Yes, there is some flexibility, but under really special circumstances. So what I would like to say is debt brake is an important tool. It's an important instrument to help the finance ministers, not only in Germany, to do the job in a way that I believe that fiscal is helping and not harming the economy.
Thank you very much, Dr. Nagel. I'd like, if I may, to turn back to the ECB and monetary policy. We discussed wage data a little while ago. If I, the risk of making you repeat yourself, I wanted to ask if wage data disappoints in June, could that in itself be enough to push cuts back until Q2 data is seen in August?
Okay, you're coming back to, let me say, what I think about what might come next. I stay where when we started this talk, that I'm a strong believer in the fact that we really have to wait for the incoming data and not speculating too much what we might do in a situation when data is coming out in a certain way. But it looks like for the moment that, as I try to stress, that April data or the April picture is not enough maybe to change the level of interest rates. And so I believe, as I said, the probability is there that maybe something could happen in June. But I wait and I will see what I will learn from the data for the next meetings. And I guess, as I said, I know financial markets, they want to know, they want to have from central bankers clear answers, certainty. But all of you listening to me, you are all professionals, you know, there is not that clear picture when it comes to monetary policy. And it is also important, one of my, let me say, my reaction functions talking to you is it needs monetary policy, needs some constructive ambiguity. Constructive ambiguity is also a very helpful tool to do monetary policy in a way that it has then at the end, when there is a decision, that impact that is intended. So I believe we will give you clarity, but it is too early to give you this clarity.
Thank you very much, Governor. Of course, we mentioned the Fed earlier. We didn't mention the BOJ, which has hiked rates, or the SNB, which has cut. Do those moves filter into your thinking in any way, perhaps if not directly?
Well, I think Bank of Japan, Japan itself, I think there's a completely different situation. I think my colleague of the Bank of Japan, he's saying that he's really different from more or less the rest of the world. And so there are some, let me say, there are some indications that maybe Bank of Japan might change its monetary policies stance. We will see. And the same, I guess, is true for my good friend Thomas Jordan and what S&P decided yesterday. I think for good reasons. I read the communication of the S&P. They decided yesterday to cut interest rates by 25 basis points. And yeah, as I already said, I think we do the monetary policy for the Euro system, not for Japan, not for Switzerland. So I'm interested to learn from others what was the reasoning for one or the other decision, and this is what I do. But I concentrate on the Euro system.
Governor, we're getting some questions in from our audience, I'm delighted to say. One of which was, where do you see the long-run neutral rate for the euro area? Isabel Schnabel believes we're at a turning point for R star and that it's shifted upwards. Do you share that view?
I think that the famous R star discussion, neutral rate, I think we discussed that during our Basel meetings a couple of weeks ago. So what I see, and also I was really interesting to learn from another BIS paper about R star and what does that mean and so on. I believe if you take, it's dependent on the model you're using, you have a, let me say, you have a rather high variety of, let me say, R stars. You got dependent from the model you're using. So I'm not sure it is, for me personally, it's a very interesting intellectual concept, but I'm not so sure if it really helps at the moment to do monetary policy and give us a clear indication what is maybe right or what is wrong. It's a good neo-Keynesian intellectual concept, but I'm still learning here. But I cannot do the same what Isabel Schnabel said and have a clear understanding where the neutral rate is for the euro system.
Thank you, Governor.
That's still an ongoing discussion, and if you check what you can take from, let me say, from academia here, there's a broad variety of views about R star. Is R star higher in the euro system in the United States compared to the pre-pandemic situation time? I do not really know.
Thank you, Governor. Another question from the audience. When the easing cycle begins, can we expect a larger than 25 basis points easing if the economy warrants it?
I think I said in my introductory statement, taking maybe the assumption that there might maybe be a first cut before the summer break this year. I said, first of all, it's dependent on the data. I have to repeat myself here. And it shouldn't be seen that there is then a kind of a guarantee that there's an automatism of further rate cuts following the first rate cut. And I'm pretty much convinced if there is a first rate cut this year, we should take a very cautious approach regarding maybe the first rate cut. So I guess this is answering this question to a certain extent.
Thank you very much, Mr. Nagel. I'd like to ask you about China. How important is China in the ECB's deliberations at present?
Well, I think when we're talking about monetary policy, maybe we have, I think, more to look at compared to what might maybe is the outlook for China. If I take the German economy, China is important for Germany. So just to give you an idea of what does a slowdown of 1 percentage points in China mean for the German economy? If there's a slowdown of 1 percentage point in China, there will be a slowdown. There are different estimations, but the slowdown will be in the range between 0.1% and 0.2%. Though there is a significant impact coming from the situation in China. But I think, coming back to your question regarding monetary policy, it seems not as relevant compared to other components that are of a higher importance when we're talking about the outlook for inflation for the euro system.
Thank you, Dr. Nagel. Again, very helpful. I have another question from our audience. What exactly has given you the greater confidence that rates can perhaps be cut before the summer break? Staff forecasts, a particular data point, and how nervous are you about the February inflation report, particularly the month-on-month pickup in core numbers?
I think core is still pretty streaky, so I think this is one of the things I would like to see, that core inflation is going down further. But where I take my confidence is related to the projections we did in our March meeting, and it gave me the confidence that there is a high probability that we can achieve our target on average next year to go to 2%. So this is a reason why I say, well, if we stay on track here, and maybe we shouldn't be still. There's no time for complacency. This is also for sure. We shouldn't declare victory about inflation too early. And yes, it is right. So the last mile, the last kilometer is this is the most difficult one in every interest rate cycle. And we should stay our course. I know there is often this, let me say, if you receive the first data that gives you maybe that idea, well, we achieved what we wanted, but we had also some episodes in the past where monetary policy were too enthusiastic, too optimistic, and then the cut came too early. And we all know at the end you have to pay this with a higher price when inflation is coming back. So as I said, 2 years of monetary policy with 10 rate hikes, and at the end, a situation where we have now an outlook that inflation is coming back to 2%. We should more or less stay what we did over this 2-year horizon, and don't become too nervous and maybe too over optimistic about the inflation picture. We need a little bit more clarity here, especially when we're talking about core inflation.
I understand. Thank you. Thank you, Governor. We haven't, of course, touched yet on the ECB's operational framework, the results of which we got last week. The outcome calls for a much smaller structural portfolio. Looking at the average maturities of the current portfolio would take rather a long time to reach such a comfortable level. Would you argue for the need to start actively selling in secondary markets as the BE does? And related to that, why was the sort of the balance sheet endpoint left so undefined?
I think, Luke, thank you very much for this question. So when I have to start from maybe beginning with my career at the Bundesbank. When I started my career at the Bundesbank as an economist, my first job at the Bundesbank was on a daily basis to calculate the so-called, or give maybe the numbers that at the end led to the excess liquidity. So the excess liquidity, the calculation that is so important for central banks. And before 2008, before the Lehman collapse, the excess liquidity was on average more or less zero. Now we are still in a situation, after all what we had to do, QE, that excess liquidity in the euro system is roughly around 3.5 trillion euros. So we are still in a situation of ample liquidity. So this is more or less the starting point for my argument when I'm referring to the new operational framework for implementing monetary policy. The operational framework of a central bank, this is more or less the heartbeat for what we have to do when we're talking about monetary policy. So this is very important that we fix all the things that giving you, the market participants, the indications, what we have in mind when we are talking about implementing monetary policy. So I was really a strong believer in the fact that, and I changed my mind here, because a couple of years ago, I thought this crisis management is over when we are going back to the old system. But I learned that will not be the case anymore because of the simple fact the market structure changed. And so the new policy framework, or the new operational framework, is giving, I guess, this is a reflection of what changed within the markets. And so I believe this is an important signal. And also we agreed that we have a review of this operational framework in 2 years' time. So there is enough time to see how the market is reacting on what we published a couple of weeks ago. Excess liquidity is coming down in the way we agreed on, because we said a couple of months ago that we stopped our purchase programs, that we let all the assets maturing. And so excess liquidity is coming down on a monthly basis. And then yes, it is also in the new operational framework, there is the possibility of a structural portfolio, but it is too early to speculate how big that structural portfolio might be and how might be the composition of that structural portfolio. For me, it's much too early to speculate about this, but I'm still behind this decision that there is in the future this possibility of a structural portfolio. But we have time to see and assess and learn how the market is reacting on all what we published a couple of weeks ago.
Thank you very much, Governor. If I could turn attention again back to Germany for a moment. Growth is looking fairly stagnant at the moment, and one wonders indeed where better growth is likely to come from, given that manufacturing and the construction sectors are both experiencing some fairly tough times. Is it perhaps also the case, and as I think it's been suggested by Philip Lane and Hernandez de Cos, that monetary transmission is proving stronger than expected for Germany in particular?
I think we did our own research here at the Bundesbank, and we came to the conclusion that we do not see this indication that the monetary transmission is stronger compared to previous rate cycles. So I do not buy this argument. I think this is what we see, or what we see is more or less pretty much comparable to what we had from other rate hike cycles. So this is not something where I put too much emphasis on. What I learned is that the 10 rate hikes did what was the intention of these rate hikes. They brought inflation back, and this is good news per se. So I'm not too much worried about this. So what we see at the Bundesbank when we talk about the second half of the year is that growth is coming back because of the wage development. Consumption will improve from the good wage development here in Germany. And also what we see is that there is a good probability likelihood that also foreign demand is coming back. And that is not enough to get to a level that I would like to see when we're talking about German growth, but it is enough to have a situation for this year that this year looks a little bit better than 2023, and then there is more optimism for 2025. But there's still the necessity that we have to talk about all what is necessary to have on a longer term higher growth rates, not only for Germany, for whole Europe, because this world is a very competitive world. So Europe is a little bit losing ground here, losing maybe wealth, and this is for me not acceptable. So we have to work on the capital market union. Maybe we have to also think about what is also a banking union. Is this possible? And we have to give good answers regarding the energy situation, digitalization. All these future projects are of utmost importance to get Europe better for the next years.
And on a related theme, Governor, I mean, would you expect the first stages of any ECB easing cycle to boost demand for credits from both households and companies? Would that even be desirable until inflation is actually back at 2%?
I think it was a rather, complicated situation. I think, yes, we were all in a situation that nobody could foresee two and a half years ago, that we are ending up in a situation that we had in a really short time to hike, because of the obvious reason, 10 times interest rates. We also have to take into account that we came from a situation where interest rates were really on super low levels. And that was one of the things the Bundesbank and my predecessor mentioned several times, that market participants should be prepared, that this is not a God-given, that this is forever, that you have to really see a situation that there is maybe a point in time coming where we will see a turnaround of interest rates. But for sure, nobody could have foreseen that it is like this, that we had to go up 450 basis points. So it was complicated. So yes, it had significant impact on credit loans and all what is more or less being part of that transmission mechanism that is necessary to bring inflation down to levels that are being perceived as price stability. So it was necessary what we did. Yes, there is a certain probability, and then is something that is also, yeah, this would be then a positive outcome of the situation when there is maybe a future rate cut, that this is also then helping the industry, consumers to go back on levels that are higher compared to 2023 and 2024. And this is then also positive for the whole economy. Yes, there is a certain probability.
Thank you, Governor. A lot of our discussion today, and indeed a lot of discussion generally, has been on wage developments. And I have to return to them again, I'm afraid. If inflation does continue to decelerate, but wages remain sticky, what will the ECB's reaction function be? Is there a danger that the Governing Council could end up targeting wages over inflation?
Yeah, this is pure speculation. I think, first of all, it looks like, and it was always the case comparing the current situation with previous cycles, I think wages are lagging. This is a lagging indicator. So we all know that we have to take all the analysis capacity to find out, is it more sticky? Is it something that will stay on a certain level and not going back where we see it could not have a negative impact on our inflation target? But at the moment, it is, as I said, and I have to reiterate on that, it is too early to come to this conclusion. I think what we currently see is still more or less this is the result of the high interest of the high inflation rates we saw 2022 and 2023. This is the reason why it is a lagging indicator. And now we have to find out if this is something that is diminishing over time. And it looks like, and if it goes the same path, it's going in the same way like it was in the past, then I believe it is something that is diminishing over time. But as I said, we need more clarity here. So I will stick to my position that this is the reason why I believe it is so important to have this meeting-to-meeting approach.
Indeed, on that theme of a meeting-by-meeting, data-dependent approach, I do wonder, however, how high the hurdle is for you to remove your possible support for a pre-summer cut. If, for example, the 2025 staff inflation projection is revised upwards by 0.1, 0.2 percentage points, and services inflation remains sticky, would that give you pause for thought as to whether to support a cut along that sort of time frame?
Look, now I'm using that argument that I tried to develop a couple of minutes earlier, is that I know my hurdle, but I will not tell it. This is constructive ambiguity.
Thank you, Governor. We have another question about Germany, this time about the German labour market. Do you see signs that it's slowing down?
Yeah, I think there are some, like, not still amazing. It's interesting. I think this is this phenomenon that we're in a situation of more or less zero growth, and labor market, and this is per se good news, is still close to is close to full employment. So it seems to be a remaining phenomenon that doesn't change too much over the course of this year. This is what we see on the Bundesbank side in our what we forecasted. So that will not change too much. So labor market in Germany will remain strong this year and also for 2025. We know the reasons. We are in an aging society, demography. So maybe companies have, in a situation like this, maybe the outlook for the company is not very good, but they have this tendency to hoard some labor forces to keep them in the company. So it seems to be the case that this is not changing too much. And this is good news, not only for the economy, it's good news also for the fiscal side. And so there are some good, let me say, elements or maybe developments that also occur or take place in the labor market that is helping the economy to take maybe again in the second half of the year a stance where we can really then report higher growth rates compared to, let me say, 2 years before.
Thank you very much, Governor. We're coming up to 10 to the hour. We have 10 minutes, perhaps a couple more left. So again, I would invite the audience to send through any last questions they have. But I wanted to ask you, Dr. Nagel, if you see any financial stability risks on the horizon. How concerned are you, for example, that the commercial real estate sector may be a growing problem for Eurozone banks and financial stability generally? Do you think easier borrowing costs will help, or is it perhaps more of a structural issue?
Maybe before I come to that part of the question, I think also here we learned a lesson over the last 2 years that I guess that the whole Euro system, whole Europe, the European banks, they are more stable, more robust compared to maybe 10 years ago. So we did a lot since the financial crisis, so that the situation where in a much better capital situation, liquidity situation, we are much better. So all the, let me say, the volatility that came from Silicon Valley Bank and also Credit Suisse did not trigger a situation where we had really a financial stability issue. So this was really good news, that the whole framework, the whole setup for the financial sector, banking system in Europe seems to be much better compared to previous episodes, decades. So this is good news. Yes, there are some, let me say, concerns regarding the CRE market, commercial real estate market, but also I believe here that it seems to be that the risks are there are no real concentration risks. So I do not see a situation where out of this, taking the assumption that maybe we see more, let me say, negative price developments in the CRE market, it seems not a situation is coming up that is triggering a financial stability case. So we are prepared for that. We are looking at this very cautiously and trying to find out, are there maybe blind spots that we do not cover? But what I see for the moment is that we will have here a full picture of data related to all what is happening in that market segment. And it seems to be that we have all the capability to manage a situation, even when the situation is getting worse.
Thank you very much, Dr. Nagel. I have a question here on the EU's new fiscal rules. And specifically, would you expect them perhaps to have an impact on the ECB's use of TPI? And then I suppose related to that, somewhat, what do you feel about the greater use of mutualized EU borrowing in general, perhaps to fund defense?
Okay, let me first start with the European fiscal rules. First of all, it was good that there was a decision to have this fiscal rule. So there was a joint understanding that there is this necessity to really come to an agreement. It took a while to come to that agreement, but some of you know that the Bundesbank were not too over enthusiastic about, let me say, the rules and how the rules are being more or less how the rules change. And we still see here a lack of transparency. There are too many, let me say, elements where we find maybe too much discretionary room to negotiate, to find maybe a solution how to get to your debt to GDP target. So this negotiation, let me say, freedom that is given in that in the new fiscal rules is maybe a little bit too much. So it is now very decisive that the rules are brought into practice. That debt to GDP ratios, they have to go down. I think if the case, then I will stop my criticism and everything is fine with me. But yes, the important thing is really that these rules are brought into practice. This is the most important thing, taking the decision that was taken at the end of last year. Is this connected to the TPI instrument? I do not see that there is any connection to TPI, because TPI is a monetary policy instrument. In my understanding, this has nothing to do with fiscal. So the third question you have regarding defense, I will leave this decision. This is not my role as a central banker to give here advice to that really complicated situation. What does that mean for defense spending in Europe and how this could be financed? I think here's politics really in the driver's seat, and I will not give here any advice or maybe good recommendation for this very difficult decision.
Thank you, Governor. We're sort of fast approaching the end, but I had another question from a Connect client. Have you been surprised by the prolonged weakness in German manufacturing, given the high level of order backlogs? And to what extent are data issues distorting the message? For example, IP is much weaker than gross value added in manufacturing.
I think I already thought that I answered this question when I said that the manufacturing sector is still relevant. It's still on a level that is rather comparable of the years before the pandemic. So yes, there are some issues that are complicated. I think if you take, for example, the automotive sector, I think there are challenges. And as I said, we have to do our homework here, but we shouldn't more or less overdoing this argument. And this is bringing me back to this sick man of Europe picture, or maybe that some have the idea that Germany is having or is going in such a direction. I do not see that this is the case. The German industry economy, we were often very good in times when we really had to change, and we shouldn't underestimate. We really shouldn't underestimate the adaptation capacity of the German industry. So this is for me an important lesson I learned from the past. We are really proud to have such a strong SME sector here in Germany. So also foreign demand, I believe, is giving us some headwind in the future to manufacturing. So past price movements related to the energy sector have also been to the energy price have also been rather difficult, and this is improving. So I believe it gives me a lot of confidence that the German manufacturing could cope with all these headwinds, and we are trying to overcome by structural changes this let me say this complicated situation. But please, you shouldn't underestimate the adaptation capacity of the German industry.
Thank you very much, Governor. That's very helpful. We have just a couple of final questions. We touched earlier on the ECB's operational framework. We didn't discuss National Central Bank profits and losses. I wonder if you can tell me what the Bundesbank's projections for profit and loss for the next 5 years are after the 2023 loss. Are provisions large enough given the usage of the risk funds over the last 2 years?
Okay. I think thank you very much for this question, giving me again the chance to really make clear what job or what is our mandate in the euro system as central banks. What mandate do we have to fulfill? This is price stability. So we are not commercial banks. So our balance sheet has a clear focus on our mandate to achieve price stability, and this is the reason why I had to announce for the annual results for 2023 a loss for the Bundesbank of 21.6 billion euros. I think this loss was most of this loss was covered by provisions. Now there are no provisions anymore. So I said it in our press conference that we expect more losses to come for the next years. But this is not something where we should really be too concerned, because we still have a very robust balance sheet. So we can cover and maybe cover all what is necessary to really come to a point that we can do what we have to do in the governing council to do decent monetary policy. Then, because of the business model of central banks, there will be future profits. And in the first phase, when there will be future profits, these profits will be used to cover the losses from the past. And we're building up new provisions. And then maybe the time is coming where I, or maybe one of my, let me say, followers, they have then the pleasure to say again that there are profits, and that will make the finance minister more happy. But as I said, on a serious note here, the Bundesbank balance sheet is sound, and we are doing what is necessary as a central bank, bringing inflation back to our target. And yeah, this is what I can say about the balance sheet of the Bundesbank.
Thank you very much, Dr. Nagel. That was very clear. And indeed, I'm very grateful to you for all of your excellent answers today. I have a final question. You've spent nearly 20 years now in central banking. Is it getting any easier?
Ooh. Well, so I love my job. I love what I do here with my colleagues at the Bundesbank. And also, I'm proud to be part of the Euro system. This is really teamwork in the Euro system. So a joint understanding of my 25 esteemed colleagues here in the governing council. I think this is really what I did the last 20 years: work for price stability, working for Europe. And so my perception is that there were many times since I'm in the business where things were complicated. But good news was that we showed in all the situation we were really in, that there was maybe a bumpy road ahead of us, or there was maybe rough water, stormy times. We showed the capability, or we had the capability to really solve this, and we came with good solutions. And so I'm positive that that will also be the case for all what might be coming in the next years. And so you see that I'm a very positive person. This has nothing to do that I'm one day away from my Easter vacation, but I'm a central banker by heart. So thank you very much for listening to me.
Thank you very much, Dr. Nagel. Our time is up. And I think that is, in fact, an appropriate moment to bring this MNI webcast to a close. Again, to President Nagel, we at MNI would like to express our gratitude to you for joining us today and generously sharing your views on these critical matters. You've provided us with, I think everybody would agree, an absorbing session. I'd also like to thank our audience today for joining us, and to those among you who raised questions. Wherever you are, please enjoy the rest of today. And I invite you all to please disconnect. Dr. Nagel, thank you very much once again.
Thank you very much to all of you.